Now let's talk about contingent liabilities. So these are liabilities that are contingent or depends on some other outcome that can happen in the future. So as it says here, some liabilities may arise from past transactions only if certain events occur in the future. These potential obligations are called contingent liabilities. The accounting for contingent liabilities depend on two important factors. One of them is the likelihood of occurring, or sometimes we call it the probability of happening or the chance of happening. And the other one is measurement. So likelihood of occurring is classified as probable, reasonable, or remote. To be more specific, we can call it probable if it's highly possible that's going to happen. Reasonably possible if there's a high chance of happening, but it's not probable. Or it's remote if it's far from happening. When it comes to measurement, the ability to estimate the potential liability is classified as estimable or not estimable. So please remember that when it comes to likelihood, we have three levels of assessing the likelihood. When it comes to measurement, it's only two levels. Either we can estimate it or we cannot estimate it. So if a contingent liability is probable and the amount of the liability can be reasonably estimated, it's going to be recorded and disclosed in the financial statements. The liability is recorded by debiting an expense and crediting a liability. So let's see an example. Assume that during June, a company sold a product for $60,000 that includes a 36-month warranty for repairs. The average cost of repairs over the warranty period is 5% of the sales price. The entry to record the estimated product warranty expense for June would be as follows. So as you can see here, the example is about selling a product, and this product has warranty, and we don't know if we will have to use this warranty that we provide for our customers or not, because sometimes a product would work fine. Some other products might have some issues within the first 36 months. So, and that's why it's hard to know the exact value. So what we do is that we create this kind of product warranty payable liability account. So the journal entry would be first recording the amount of our sales, which is $60,000 multiplied by 5%, which is the warranty, the average cost of repair, which is 5% of the cost of our sales. So it turned out to be $3,000. So we're going to debit product warranty expense, and that's going to be debited because all expenses, as we know, should be debited. And then we create this kind of liability account, which is the product warranty payable on the credit side for the same value. When something goes bad, like a product comes to us because it has a defect or a problem, then we're going to use from this kind of liability account, we're going to reduce it. So we're going to debit it, and then we're going to credit the things that we spent. And we'll see that in the following slides. So if the product is repaired under warranty, the repair costs are recorded by debiting product warranty payable and crediting cash, wages payable, or other appropriate accounts that are related to fixing the problem. So let's assume that a $200 part is replaced under warranty on August 16th. So the journal entry to record the replacement of the defective part would be as follows. We're going to debit the product warranty payable because we're going to reduce this liability as we created it at the very beginning when we sold the product. Now something went wrong, so we're going to remove this liability. So we're going to debit product warranty payable for $200, and then since this was a supply part, then we're going to credit supplies for $200. What if we have a contingent liability that's probable, but we cannot estimate the value? So a contingent liability whose occurrence is probable but not estimable is disclosed in the notes to the financial statements, but we're not going to record any value. By disclosing, we mean we just have a footnote, like a short, brief note that would just explain that we have this kind of probable contingent liability, but we cannot estimate the value. What if it's reasonably possible? So if it's reasonably possible, it doesn't matter whether we can estimate the value or we cannot estimate it. So contingent liabilities whose occurrence is reasonably possible is disclosed in the notes to the financial statements. So in this case, we're going to also have a footnote in the financial statements explaining that we have this kind of contingent liability that's reasonably possible. How about if it's remote? If it's remote, we don't need to disclose any kind of contingent liabilities in the financial statements. So no disclosure needed or needs to be made in the notes to the financial statements for contingent liabilities whose occurrence is remote. And by remote here, we mean it's far from happening. The following slide would just give us an idea of how we can remember these different scenarios. So remember, contingencies can be probable, could be reasonably possible, or could be remote. If it's probable and we can estimate the value, then we record it and we disclose the liability in the financial statements. So we record it in the body of the financial statements and we have a disclosure in the footnotes section of the financial statements. If it's probable but we cannot estimate the value, then we only have a disclosure in the footnotes. If the contingent liability is reasonably possible, we don't care about the measurement. Whether it's estimable or not estimable, we're going to disclose it in the financial statements. In other words, we're just going to have a footnote without recording it in the body of the financial statements. If it's remote, if the contingent liability is remote, then we're not going to do anything. There's nothing that's going to be recorded. There's no accounting treatment for that. Finally, let's see how we report the liabilities in the financial statements. As we know, liabilities, they belong to the balance sheet. They're part of the balance sheet. So you can see here we have current liabilities and we have long-term liabilities. Under current liabilities, these are the liabilities that have to be fulfilled within a period less than 1 year. And we have here accounts payable. We have the notes payable, which is only the current portion, which is the amount that has to be paid in a period less than a year. We have salaries and wages payable. We have the payroll taxes payable. We have interest payable. And then for the long-term liabilities, we only have notes payable. And this is for any kind of note that's going to mature in a period longer than 1 year. Last thing in this chapter, we just want to do some kind of analysis for decision making. And one thing that we're going to learn today is something called the quick ratio. The quick ratio is a continuation of the current ratio. So current position analysis helps creditors evaluate a company's ability to pay its current liabilities. This analysis is based on the following 3 measures: the working capital, current ratio, and quick ratio. So just to refresh your memory, working capital is computed as follows, where we get the current assets from the balance sheet and we subtract the current liabilities, which are also in the balance sheet. So it's simply the difference between the current assets and the current liabilities. If it's a positive number, then this is good news. If it's a negative number, then it's dangerous. The current ratio, instead of subtracting current assets and current liabilities, you're going to divide current assets by current liabilities. And if it's over 1, then again, you're safe. If it's below 1, then the situation is a little bit dangerous because you have more current liabilities than your current assets. While these 2 measures can be used to weigh a company's ability to pay its current liabilities, they do not show the company's ability to pay these liabilities within a short period of time. This is because some current assets, such as inventory, cannot be converted into cash as quickly as other current assets, such as cash and accounts receivable. So that's why they came up with the quick ratio. Sometimes they call it the acid test. So the quick ratio excludes inventory and prepaid expenses from the assets. So it only focuses on cash and other current assets that can be easily converted into cash, such as temporary investments and accounts receivable. So, as it says here, a quick ratio overcomes the limitation by measuring the instant debt-paying ability of a company. How can you pay your current liabilities as soon as possible? That's the main purpose of this ratio. So how we calculate it? It's quick assets divided by current liabilities. And what are the quick assets? These are cash and other current assets that can be easily converted to cash, such as temporary investments and accounts receivable. So let's see an example. Consider the following data for a company called Tech Solutions Incorporated at the end of the recent year. You can see here they have their current assets, their total current assets. They have their total current liabilities. So we can calculate the working capital as the current assets minus the current liabilities, which is the difference between the 9180 and the 5400, and it turns out to be 3780, which is a positive number. That's good news. The current ratio is the current assets divided by current liabilities, and that's 1.7. So simply we got the 9180 divided by 5400, and that turned out to be 1.7. Again, as long as it's over 1, we're in good shape. The next thing we want to do is to calculate the quick ratio. So just to highlight the quick assets, these are going to be cash, temporary investments, and accounts receivable. So we have to add the first three numbers here, the 2020, the 3400, and the 1600, and we divide it by the total current liabilities, which is the 5400. So you see here the quick ratio for Tech Solutions Incorporated will be computed as follows. We have the 2020, we have the 3400 plus the 1600 divided by 5400, and the ratio turned out to be 1.3. So this is again still a safe ratio. As long as we're above 1, this means that we have the ability to satisfy all our current liabilities using our quick assets. One thing I want you to notice is that this quick ratio should always be below the current ratio. So you can see here the quick ratio is 1.3. The current ratio was 1.7. So the quick ratio is always less than the current ratio. So a quick ratio above 1.0 indicates that the company has more than enough quick assets to pay its current liabilities in a short period of time. So by that, I conclude Chapter 10. Thank you for listening. I wish you all best of luck. Please let me know if you have any questions.